Today we're going to start with IAS 16, and that is all about property, plant and equipment. Now, property, plant and equipment is so important that there are 3 IAS statements that is handling property, plant and equipment and all the issues associated with that. In the first year, though, we only touch upon a portion of IAS 16, and next year you will continue with this subject once more. What do you have to know this year? Number 1, which costs form part of property, plant and equipment, for short PPE. Apply the different depreciation methods. So what methods can we use in order to provide for depreciation, and how does each one of them work? And then we have to be able to record purchases, we have to be able to record disposals, and inclusive in disposals will be disposals made at a loss, or either it can be a trading transaction, so you must know how to record a trading transaction. You must understand what the VAT implications are, and then obviously you must be able to calculate the depreciation and the impact of that on either the profit or loss that you have realized. Furthermore, we can get insurance claims for the loss of property, plant and equipment. And in this instance, the way that you're going to calculate that by applying the averaging clause is exactly the same as for inventory. You have to determine what was the total value of the property, plant and equipment that was insured. You're going to get the insured value divided by the total value of the property, plant and equipment multiplied by the loss incurred. And then obviously you have to know how to do the applicable accounting entries and the disclosure. Always disclosure, disclosure, disclosure in the financial statements. Good. Now, property, plant and equipment. In school you have referred to it as fixed assets probably. The more correct IAS wording attached to that is non-current assets. Now, what is the definitions according to IAS 16? For certain items of property, plant and equipment? It says, number 1, it can be tangible. Now, there's tangible assets and intangible assets. In the first year, we do not do intangible assets. You're only going to do that in your second year. Now, property, plant and equipment is held for use in production or supply of services, or for rental to others, or for administrative purposes, and are expected to be used during more than one financial period. Now, guys, the receiver of revenue doesn't have a lot of things that's very clear, and it doesn't use a lot of images that makes a lot of sense to most of us. But there's one image that he uses, which absolutely describes what property, plant and equipment is. The receiver says it's like a tree. He says the property, plant and equipment is the tree. The fruit that the tree actually bears, that fruit, that is the products that you're going to use. By selling that product, you're going to make a profit. So the tree, the thing that actually going to produce the fruit, that is the property, plant and equipment. The tree is not going to die within 1 year. The tree you're going to use over a number of periods. So the tree for this, in this case, will be held for the use in the production of fruit. It can be also used for supply of services. For rental, let's say that I have cars and I do rent my cars out. So then those cars are definitely part of my PPE. I actually generate income from rental, my PPE. Administrative purposes, it's like admin building, it's like office furniture, things that I use in order to make my company tick. And then the most important one, it is used for more than one financial period. Now, what is the carrying amount of an asset of PPE? And that is the amount at which the asset is recognized after deducting accumulated depreciation and accumulated impairment. Now, impairment we don't do this year either. So for your first year studies, it is all about what was the cost price of the asset, and there you have to again be able to define what can you capitalize as part of the cost price of the asset, and then you can deduct the accumulated depreciation, i.e. the total write-off of that asset over its estimated lifetime from the cost price, and the difference between the two equals the carrying amount of the asset. So the carrying amount is the cost price of the asset less accumulated depreciation on the asset. What is the depreciable amount? Now the depreciable amount is the amount that I want to depreciate over the estimated lifetime of the asset. So that is the cost price of the asset minus its estimated residual value. Now cost price, again, you must determine what can you capitalize and can form part of the cost price of the asset. The estimated residual value is the value that I expect to get of this asset at the end of its lifetime should I sell the asset. So that is the estimated residual value of the asset. The estimated value of the asset at the end of its useful life in today's terms. What is the useful life of the asset? That is the period during which the depreciable asset will be used by the entity, or if this is a machine, for instance, and the machine has the capacity to produce 100,000 units, then that 100,000 units would be its estimated useful lifetime, because that is the total capacity that you will be able over its lifetime to produce. What can I now capitalize as part of the cost price of PPE? Now, obviously, like in inventory, this works exactly the same as inventory. It's nothing funny. The first thing is the purchase price after the deduction of any discounts. Same story as inventory. Same story as inventory. Installation cost. If I need to install the asset before I can start using the asset, then the installation cost form part of the cost price of the asset. If I had to incur delivery cost in order to get that asset in my possession, to enable me to use it for the purpose it was acquired for, now in this case the purpose would be to use it for more than 1 year to produce items that can give me income over the estimated lifetime of the asset, then I can also capitalize the delivery cost. If this entity is not a VAT vendor, but he bought the asset from a VAT vendor, then he cannot claim the VAT from the receiver of revenue because he's not a VAT vendor. In that case, then, the VAT becomes a non-claimable duty and the VAT must be capitalized as part of the cost price of the asset as well. Same, no difference here than anything that we've done on inventory. Now, what does the cost of PPE excludes? Well, if I'm a VAT vendor, I can claim the VAT, so then I cannot capitalize the VAT. And the same as with inventory. Any administrative overheads, like salaries, like training costs, like promotional costs, all those costs form part of admin overheads, and you're not allowed to capitalize that as part of the cost price of an asset. Now, PPE can be measured in two ways. The first way that we can measure it is the cost model. The other one here, behind this little cross, which you cannot see in our side, is the revaluation model. Now, the revaluation model, we're not going to bother with this year, but the revaluation model you're going to do next year. So we're not going to bother with the revaluation model. What is the cost model? The cost model is the historical cost of the asset, so it's the cost at which the asset was acquired for, plus all the costs that you are able to capitalize as part of the cost price of the asset. That all form part of the cost price of the asset. And then I'm going to write off that asset, that cost price of the asset over its estimated lifetime. So for instance, if I bought an asset of 100,000 Rand, and I think the useful life of that asset is 10 years, then I'm going to write it off at an amount of 10,000 Rand per annum. So at the end of year one, I'm going to show the carry value of the asset at the cost price of 100,000, less accumulated depreciation of 10,000, which will give me a carry value of 90,000, and the 90,000 will be reflected as the value of PPE in the statement of financial position. Now, in order to create accumulated depreciation, I'm going to debit an expense account depreciation, and credit accumulated depreciation. Now, the expense account is being closed off against profit or loss at the end of the financial year. But the accumulated depreciation is the negative part of my asset. So therefore, the accumulated depreciation will be posted against the cost price of the asset to the statement of financial position, i.e. the carry value, cost less accumulated depreciation equals the carry value, and the carry value will be reflected on the face of the statement of financial position. Good. Now, depreciation. Let's talk a little bit more about depreciation. What is depreciation? It is a systematic allocation of the depreciable amount of an asset over its estimated useful lifetime. Remember here we said what is the depreciable amount? Somewhere. Depreciable amount is going to be the amount that we're going to write off over the estimated useful lifetime of the asset. Good. We also said that the depreciation is an expense account. The counter leg of that entry is debit the expense account depreciation, credit the accumulated depreciation account. Now, when do we start to provide for depreciation on an asset? Depreciation starts when an asset is available for use. Not at the date of delivery, not at the actual date that we're going to start using the asset, at the date when it was available for use. And guys, in the past I did let the students write that down 3 or 4 or 5 times, and then when a test or exam comes and I ask you that, then nobody suddenly knows exactly when to start with depreciation. So repeat this aloud for yourselves. Depreciation starts when an asset is available for use. Now, there are 3 methods of providing for depreciation that you should be aware of and that you should be able to apply and you should be able to do the calculations of. Number 1 is the straight line method. Now, the straight line method says each and every year over the estimated lifetime of the asset, I am going to write off exactly the same amount of depreciation. Like in our previous example, over a 10-year period, on an asset of 100,000 Rand worth, I'm going to write off 10,000 Rand per annum. The diminishing balance or reducing balance method says, here I'm going to provide for depreciation based on the carry value of the asset. So the carry value of the asset again is the cost price less accumulated depreciation. So the carry value of the asset is being used to work out what my depreciation is. Now, if I have an asset which is going to be used more when the asset was acquired and then a few years after the acquisition of the asset than what it's going to be used in the later years, then it makes a lot of sense to use the diminishing balance method because your depreciation is going to be much higher in the starting years than in the ending years of the lifetime of the asset. Why? Because my carry value diminishes over time because my accumulated depreciation is going to increase over time, which is going to make the carry value less. So each and every year that you're going to work out depreciation, it's going to be on a reduced amount. The production unit method is where the type of asset that I'm using or talking about here is something that I use like a machine, for instance. The machine's got a capacity of 100,000 units. The machine has costed me 100,000 Rand. So how much depreciation do I want to write off? 1 Rand per unit. 100,000 Rand cost price divided by the capacity of 100,000. So for each and every unit that I'm going to produce, I want to make a provision for a 1 Rand depreciation charge. So come end of year 1 and I've actually produced 20,000 units, then my depreciation is going to be 20,000 Rand. Let's say in year 2 I've only produced 15,000 units. Then the depreciation charge for year 2 is going to be 15,000 Rand. 1 Rand per unit multiplied by the number of units that I have produced. So let's look at a few examples. Straight line method. Let's assume that the cost price of this asset is 100,000 Rand. The estimated residual value, i.e. what can I get for this asset at the end of its useful lifetime, is 5,000 Rand. The useful lifetime is 10 years. How much is the depreciation in year 1? Now the depreciable amount is the cost price of the asset less the estimated residual value. So that gives us 95,000 Rand. That's a depreciable amount. The useful life of the asset equals 10 years, so 100 divided by 10 gives me 10% per annum. So in year 1, my depreciation charge is going to be my depreciable amount of 95,000 multiplied by 10%, which gives us 9,500 Rand. What is the entry that we're going to pass in our books? We're going to debit my depreciation expense account with 9,500 Rand. We're going to credit accumulated depreciation, which is a negative asset. It is the credit side of my asset account, but we just do that in a separate account. Why? Because if I'm the reader of the financial statements, I would love to know what was the cost price of the asset and what was the accumulated depreciation that we've written off that asset. And then also in the question, I will be able to derive at what was the useful life of the asset, which in total what was the useful life and which portion of that useful life has lapsed. So how much of that useful life have I used? Why? If an entity does not have a proper plan to replace its non-current assets, remember this is his income producing capacity. If he doesn't have a proper plan of maintaining that production capacity of him, that income producing capacity, then it means over time that capacity is going to deteriorate. And that means over time his ability to create income out of that asset is going to diminish. So if an entity does not spend enough money to replace its old assets and to make sure that it maintains or even increases its income producing capacity over time, this entity is not going to exist in the distant future. Good. In our statement of financial position, what are we going to reflect? The carry value of the asset. What is the carry value of the asset? Now, watch out, not 95,000 less 9,500. 95,000 was only the depreciable amount. The carry value of the asset is the cost price of the asset, 100,000 Rand, less the depreciation, the accumulated depreciation, and at the end of year 1, it's only the 9,500 Rand, less 9,500 Rand, which equals 90,500 Rand. And that we will label as a non-current asset in a statement of financial position. Good. Now the diminishing balance method. Now guys, there's a catch in the diminishing balance method. We have a cost price again of 100,000. We have an estimated residual value again of 5,000. And we're going to have depreciation based on 20% on the diminishing balance method. Now, the diminishing balance method is the only method, and listen very carefully, where you ignore the estimated residual value. And you seem to ignore the estimated residual value. But that estimated residual value has already been discounted into this 20%, which you are going to use to write off this asset. So you will see 20% is a 5-year, 100 divided by 20 equals 5 years on the diminishing balance method. And you will see if you're going to apply that correctly and you work out this 20% correctly, and there's a formula, next year you're going to see the formula, but if you want to see it now, just ask me, I'll show you the formula, and which you're going to calculate. And it's square roots and all kinds of funny things. You calculate based on the estimated residual value over a 5-year period. You want to use the diminishing balance method. What percentage should you write off on an annual basis? So I'm going to repeat myself. Included in that 20% is already the diminishing balance of 5,000 Rand. So yeah, at the end of year 5, you're going to see that you're going to remain with a balance of that PPE item in your books of 5,000 Rand. So for academic purposes and for question purposes, if I'm going to use the diminishing balance method and I give you the estimated residual value, you have to ignore the estimated residual value and only apply the 20% balance on the carry value of the asset at the beginning of the current financial period. So again, the same information as the previous example. But now in year one, we ignore the 5,000 and on the diminishing balance method, we're going to provide 20% on 100,000 Rand, which equals 20,000 Rand. So we're going to debit our depreciation expense account, 20,000 Rand, and we're going to credit our cumulative depreciation account at the end of the year with 20,000. In our statement of financial position, what is going to be the carry value of the asset? The 100,000 cost price, less the accumulated depreciation of 20,000, which gives us 80,000, and that will be formed part of our non-current assets. In year two, what is going to be our depreciation charge based on the diminishing balance method? Now, at the beginning of that year, the carry value of the asset was 80,000 Rand. 80,000 Rand times 20% gives me 16,000 Rand. So in year two, I'm going to debit depreciation with 16,000, credit accumulated depreciation with 16,000. At what value are we going to show our non-current asset in the statement of financial position in year two? Cost price of 100,000. Less accumulated depreciation now of 36,000. The first year is 20,000 plus the second year 16,000, 36,000, and that will give us then a net carry value of 64,000. In year three, you're going to base your depreciation charge as 20% then of 64,000. With the production unit method, let's assume that ABC Manufacturers buys a machine for 100,000 Rand exclusive of VAT, and they are expecting to produce 10,000 units from this machine. The expected residual value at the end of the lifetime of the machine is 10,000 Rand. Let's assume in year one that we have manufactured 2,200 units. Now here we have to work with the depreciable amount again, and the depreciable amount is like with the straight line method, 100,000 less, there's the English, less the estimated residual value of 10,000. So the depreciable amount, 90,000. What is the total capacity of this machine? Total capacity is 10,000. So how much depreciation are we going to write off per unit? 90,000 divided by 10,000 equals 9 Rand per unit. How many units have we produced in year one? 2,200 units. So in year one, we're going to get the 2,200 units multiplied by 9 Rand a unit, which gives us 19,800. In year two, we have manufactured 3,100 units. So in year two, it's going to be 3,100 units. The 9 Rand per unit stays the same. There's 9 Rand coming from the depreciable amount divided by the capacity. 9 Rand per unit. So in year two, 27,900. Again, your accounting entry stays the same. In year one, depreciation debit, 19,800. Accumulated depreciation credit, 19,800. In year two, depreciation debit, 27,900, accumulated depreciation credit, 27,900. So in this method, you can clearly see the more I'm going to produce, the higher my depreciation charge is going to be. And it seems logical because the more you're going to use, the more of the asset you're going to use up in that specific period. So therefore, the depreciation charge must be higher. Let's just have a look at the disclosure of this machine in our financial statements at the end of year two. On our statement of financial position, you will have assets, underneath assets, non-current assets. Then the cost price of this asset was 100,000 Rand, total cost. Our accumulated depreciation will then be the 19,800 plus the 27,900, which gives us a total of 47,700. So the carry value at the end of year two, 52,300. Now, this cost and accumulated depreciation I will show you the note a little bit later on, but that is shown in the note to the non-current asset, PPE. You are only going to show on the face of the statement of financial position the carry value of the asset of 52,300. Good. Now what happens if we get rid of an asset? How can we get rid of an asset? We can sell the asset, or we can trade in the asset. Very often when we have a motor vehicle, usually we trade in our old motor vehicle for a new motor vehicle. Or there can be a loss due to fire or theft, the same as what happened with the inventory. Good, let's have a look at the first thing. And we have done some of these calculations already, and we've done a lot of these journal entries already. So this is really just to refresh your memory. Let's say ABC Traders, which has the 31 December 2013 year end, owns the following equipment at the beginning of that financial year. The cost price of the equipment was 100,000. The accumulated depreciation of the equipment was 20,000. So it means at the beginning of the year, the carry value of the asset was 80,000. The vehicle is sold on 1 July 2013 for 60,000 Rand. Now, the first thing that you should ask yourself, we have got a 31 December year end. The first thing that you should ask yourself always is, did we use this asset in the current financial year? And if the answer is yes, then before you can go and account for the disposal of that asset, you must first provide for the depreciation on that asset for the current financial period. We are writing off 10% depreciation on the straight line method. So that gives us a depreciation charge of 10,000 Rand per annum. If we have used that asset for half a year, from the 1st of January to the 1st of July, it gives me 6 months, then it means that we have to provide for 5,000 Rand. 10,000 Rand depreciation times 6 months equals 5,000 Rand of depreciation in the current financial period. So, the first thing that we're going to do is we're going to debit our depreciation charge, 5,000. We're going to credit accumulated depreciation, 5,000. The next step is that we want to remove this asset out of our books. So what was the cost price of the asset? 100,000 Rand. So we're going to remove that 100,000 Rand out of our books first. An asset's got a debit balance. So if we want to take it out, we have to credit that asset account. So we're going to credit the asset at cost account of 100,000, and we're going to debit an asset realization or asset disposal account. Now, the asset realization or disposal account is just an in-between account. And the purpose of that account is to determine what was the profit or loss on the disposal of the asset. So after you've done all the accounting entries to record the sales transaction of the asset, there must be no balance left on the asset realization or disposal account. So the second thing that we want to remove is the accumulated depreciation that's in our books. But the accumulated depreciation is no longer equal to 20,000 Rand because we have posted to the accumulated depreciation for the current period an amount of 5,000. So we have to take out a total accumulated depreciation of 25,000 Rand. There was the cost price, there's the total accumulated depreciation. Accumulated depreciation is a negative asset, so it's got a credit balance. So if I want to remove it out of my books, I have to debit my accumulated depreciation account. I'm going to debit that with 25,000 Rand. And I'm going to transfer that as well to an asset realization or asset disposal account. So in my asset realization or asset disposal account, I will have now a debit of 100,000. I will have a credit of 25,000. So the net will be a debit of 75,000, which equals the carry value of the asset that I had on hand. The next step of taking or of completing this transaction is to determine what did I receive for the asset. Now let's ignore that for the moment, and we received 60,000 Rand for the asset. So we debited bank with 60,000 Rand, and we will credit our asset realization or asset disposal account with 60,000 Rand. Now the amount that's going to be left over, which will be that amount there, the amount that's going to be left over in our asset disposal account is going to an amount on the credit side of the asset disposal account of 15,000 Rand. That 15,000 Rand represents the loss on the disposal of the asset. So I will credit the asset disposal account with the 15,000 and I will debit the loss on disposal, which is an expense account, with 15,000 Rand. Now in this entry here, I have sort of combined everything together and I did not use the asset disposal account. I will strictly not recommend you to do that. Use the asset disposal account as an in-between account to make sure that you understand exactly where everything goes to. So your steps will be: transfer the cost price of the asset to the asset disposal account by crediting the cost account, debiting the asset disposal account. Take total depreciation out, so debiting the accumulated depreciation, credited the asset disposal account. Then you're going to record the proceeds on the sale of the asset, and the proceeds on the sale of the asset is going to be debit bank if it was received in cash. If somebody still owes us some money, it will be a debtor account, debit the debtor account, and credit the asset disposal account with the 60,000. Then you have to clean out the asset disposal account, so see where you need the balancing figure in order to make it balance out. In this instance, you will see that you need a credit on the asset disposal account of 15,000 Rand. So you're going to credit the asset disposal account with 15,000 and you're going to debit a loss on disposal of 15,000 Rand. Good. The second part of the question tells me that I have to go and have a look what will happen should I actually work with a VAT vendor. It says what will happen if I did not ignore VAT. Now guys, everything stays exactly the same. The cost price of the asset will still be 100,000. The accumulated depreciation, i.e. that first entry, will still be the same and the total accumulated depreciation will still be the same. The difference only comes into this line item, because let's assume that we did not receive now 60,000 Rand for the asset, but based on a 14% VAT rate, 68,400 Rand for the asset. I will still only be able to take 60,000 Rand to the asset disposal account because only 60,000 Rand belongs to me. 8,400 Rand of the amount that I've received belongs to the receiver of revenue, and I have to post that to the VAT output account. So if you look at this one here, the only difference between this transaction and that transaction is the amount received in the bank. I've received now an amount of 68,400. What is the amount that we're going to transfer to our asset disposal account? Still 60,000. And 8,400 we're going to transfer to the VAT output account. It's VAT output. VAT output account. Good. So if an entity is registered for VAT, VAT must be accounted for on the disposal of the asset. How will the previous class example differ if we assume that the entity is registered for VAT and the proceeds of the disposal is 68,400? Then 8,400 would have been posted to the VAT output account, and 60,000 would have gone to the asset disposal account, and 68,400 would have been posted against the bank account.